If this side is heavier, the markets might rise. Whereas, if the other side is loaded, then there could be a brutal fall. Let's understand how traders use put-call ratio to understand what might happen in the market. Hi, I am Pranav VK, your options trading guide here at Stockshaala by Kotak Securities. So far, we have learned a lot of tools in options trading. We started with option Greeks, and then we also learned about the various strategies that you can develop and also hedging. But this is another tool that can give you an edge over other traders, and that is put-call ratio. PCR is nothing but the number of open interest in put options divided by the number of open interest in the call options. It helps us gauge whether the market is overly bullish or if it is overly bearish. In general, if PCR is greater than 1, then it means that the total number of puts is greater than the total number of calls. What it means is that the traders are expecting a support at this level. But however, if PCR is less than 1, then the number of calls are higher, which means the market is expected to be bearish or a resistance at that specific level. But in India, it's not 1 but rather 0.75, which is considered as the neutral number. That is because India is retail heavy and they write more call options than put options. Hence, the baseline PCR slightly tilts towards the 0.75 for a neutral zone. Now let's look at an example in Nifty and interpret what might be happening in that specific chart. So here I've taken a very simple example with only single strike on either side. So for the put OI, we have 80 lakh contracts, whereas call OI, we have 60 lakh contracts. Now how do we calculate the put call ratio? It's very simple. We go with the formula PCR equals total number of puts, that is 80 lakhs, divided by the total number of calls, that is 60 lakhs, that is 1.33. So if PCR is greater than 1, we understood that mostly it is taking support at this specific level and the traders are bullish in this specific market. Another way to look at this is also, if put OI is 80 lakhs, it means that people have sold 80 lakh contracts in puts, whereas if call OI is 60 lakhs, people have sold 60 lakh contracts in calls, which also means the same meaning, but maybe this explanation would give you a better understanding. If you go back to the previous videos, we discussed about one of the indicators called as RSI, where we understood that if the value goes above 70 or 80, then it shows that it is overly bullish or overbought region and a possible reversal is there. Similarly here, if 1.33 is very bullish in this case, and it also shows overconfidence and a possible reversal is expected. Now we'll go deeper and understand how PCR also acts like a contrarian indicator. Now let's consider two different scenarios. In the first scenario, we have extremely high PCR, which is greater than 1.5, and on the other side, we have extremely low PCR, which is less than 0.7. An extremely high PCR of greater than 1.5 suggests that there is extremely high put writing, and which also means that there could be short covering and could be a trap for the bulls. Now, if you can recall, when do we do put selling? As a put seller, we are going to do it only when we are bullish on the market. Whereas, if you are selling calls, you are actually bearish on the market. Now, if you are not clear about why put writers represent the bullish market, then I highly recommend that you go and watch the option trading basics videos in the Kotak Stockshaala platform. Now, considering the first condition where we have extremely high PCR greater than 1.5, what it really means is that there is very high put writing in that specific level. So which also means that if the price starts falling a little bit, due to short covering, the prices might slide significantly, which also indicates that this might be a trap for bulls. In simple terms, the market has been extremely bullish in the past few sessions, and now at a very high level, if the bulls start buying, then at this point of time, the loss they're going to take if the market starts falling is very significant, and that is what it means in simple terms. Now, considering the second condition where there is extremely low PCR, where it is less than 0.7, which means there is extremely high number of call writing, what it means is that if the price starts going up, then sellers might start panicking, and this might be a trap for bears. Always remember, when the values are extreme, it does not signify continuation, but it signifies a reversal. Here is a pro tip. While the textbook definition actually gives us 1.5 and 0.7 as extreme numbers, what I have experienced in my trading journey is that we generally have these extreme levels at 1.3 itself on the upper side, and on the bottom side I have seen less than 0.7 regularly. So on the upside, seeing 1.5 or more might be very rare. Now let's understand how to interpret a stock PCR versus an index PCR. Starting with the indices, we are going to look at Nifty PCR as well as Bank Nifty PCR. Nifty PCR gives us the broader market sentiment, whereas Bank Nifty PCR shows us sharp reversals as well as volatility. And talking about stock PCR, it should always be used with delivery data as well as price action. So a pro tip here is that never use PCR alone for making your trading decisions. Always combine it with delivery data, price action as well as volumes. So let's summarize the PCR values and what are the possible setups that we can do for each of them. Starting with greater than 1.3, the sentiment is bullish and possibility is that it can reverse. And the setup that you can go for is a bull put spread. On the second one, it is 0.9 to 1.2 PCR. It means that the sentiment is mostly neutral and the possible setup for that is an iron condor. And the third one is less than 0.7. It represents a bearish market and possibly can reverse as well. So the possible setup for this is a bear call spread. But always remember that whenever you open the PCR value and look at it, don't make a judgment immediately, but rather compare the PCR values of today's session with yesterday's session and the previous sessions as well. So that way you will know what has been the trend in the past and whether the PCR is continuously increasing, decreasing, or if there is a shift in trend. Here are some effective ways to use PCR. The first one is to check IV levels as well as OI buildup while checking PCR as well. Second, it is best used during the first half of the trading day. Third, don't use it during event days because the data might be distorted and the number of calls and puts might be varying significantly faster. Even on expiry days, you will find a similar situation. And finally, always remember that PCR is just a number representing the number of calls and puts, which means it can be changed very fast. The number of calls might go down significantly or the number of puts might go down significantly depending on the market conditions. So don't take PCR as the only data point for taking your trading decisions. Here is a quick analogy so that you understand this better. PCR is like mood lighting. It tells you how the room feels like, but it doesn't show you where the door is. Stay tuned because you're watching Stockshaala by Kotak Securities, and in the upcoming video, I'm going to go one level deeper into sentiment analysis and we're going to learn something about Max Pain theory, which is going to show us which is the magnetic level on expiry days where the retailers lose money and the institutions win. I am Pranav VK signing off, and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.